A $10,000 investment in Nvidia in 1999 is worth approximately $75 million today. The S&P 500 over the same period turned that same $10,000 into $85,000. Three numbers that are not typos: 39% CAGR, 27 years, and a return that has almost nothing to do with AI. In this video, we're going through 8 charts. Together, they build one complete mathematical argument, from the engine that produced those historical returns to the structural forces compounding underneath, to the exact equations that determine whether this thesis reaches 10x or falls short. This channel breaks down investing using clear, data-driven charts to track where institutional money is moving and what that means for your portfolio. Quick disclaimer: this is a structured, analytical case built on public filings, not a prediction, not a guarantee, and not a substitute for your own judgment. 2 lines, same starting point: $10,000 in January 1999. The white dashed line is the S&P 500, 8.5% annually for 27 years, landing at $85,000. That beats the vast majority of professional fund managers over any comparable period. The blue line is Nvidia. It crashes through the dot-com bust, stumbles in 2008, flatlines for years. Then, notice that vertical marker at 2016? Something changes. After 2022, it goes near vertical on this logarithmic scale. Terminal value? Approximately $75 million, a 39% CAGR every year for 27 years. Most coverage attributes this to AI. That explanation is incomplete. The 39% CAGR predates AI by 2 decades. Something structural was generating these returns long before anyone said the words large language model. The next chart shows exactly what that something is. ROIC, return on invested capital, the most honest number in corporate finance, and almost no retail coverage mentions it. The gray dashed line is the S&P 500 median, around 12%. The orange dotted line is Nvidia's cost of capital, around 17%. Every bar above that orange line means Nvidia is creating genuine economic value on every dollar reinvested. Fiscal year 2023, the gaming and crypto bust, ROIC dropped to 10.91%, below cost of capital. A difficult year, but the business didn't break. Fiscal year 2025, 144.85%, 9 times the market average. That is a company generating nearly $1.50 of profit for every dollar of capital deployed. Fiscal year 2026 pulled back to 113.77%, still 9 times the market average. The 39% CAGR from chart 1 is the output. This chart is the engine. Fiscal year 2019, $12 billion in total revenue. Data center was just 26% of that. Nvidia was overwhelmingly a gaming hardware company. Fiscal year 2020 through fiscal year 2023, the bars barely move. The company looks like it's treading water. Then, the AI boom hits. Fiscal year 2024, $61 billion. Fiscal year 2025, $130 billion. Fiscal year 2026, $216 billion, with 90% coming from data center. Total revenue rose 18 times in 7 years. Here's what that means for the valuation debate. The models calling Nvidia expensive were calibrated on a $12 billion gaming company. That business no longer exists. The company in this chart is structurally different, and most of the market's mental model hasn't caught up to what the filings have been saying for years. 2 panels. On the left, developer ecosystems across GPU compute frameworks. Intel 1 AP, roughly 100,000 developers. Google XLA, roughly 150,000 developers. These are estimates. Nvidia CUDA, 6 million developers, confirmed in the fiscal year 2025 10K, 30 times more than the closest competitor. The right panel shows growth from 1.8 million developers in 2020 to 6 million by 2026, plus 233% in 6 years. Three numbers in the corner: 600 GPU-optimized libraries, 3,500 CUDA-accelerated applications, 500 million CUDA-enabled GPUs installed. The moat, in plain English: if your entire research code base runs on CUDA, every library, every pre-trained model, every workflow, switching to a competitor means rewriting years of work. The friction isn't a software upgrade. It's an institutional restructuring project measured in engineering years. CUDA turns customers into long-term relationships, and that relationship has been compounding for 18 years. Quarterly revenue from Q1 fiscal year 2024 through Q4 fiscal year 2026, $7.2 billion to $68.1 billion, a 9.5x increase in 8 quarters. But the right panel is where the thesis becomes structural. Hyperscaler AI CapEx for 2026, publicly committed, not forecast, stands at over $700 billion. Goldman Sachs projects cumulative hyperscaler AI CapEx from 2025 through 2027 at $1.15 trillion. The critical point: this spending is not discretionary corporate R&D that gets cut when earnings miss. It is geopolitically motivated infrastructure investment. These companies are not building AI capacity because it's trendy. They're building it because falling behind is an existential competitive risk. That is a demand floor with a fundamentally different durability profile than typical tech spending cycles. 3 lines. Nvidia net margin in blue, Nvidia gross margin in orange, Microsoft's net margin during its cloud transition in gray, shown as a structural analog. Nvidia's net margin, 35% in 2019, drops to 16.2% in 2023 during the bust, then launches to 55.9% in fiscal year 2025, holding at 55.6% in fiscal year 2026. For context, Microsoft's net margin during its celebrated pivot to Azure peaked around 36%. Nvidia's is now 55.6% on $216 billion in revenue. Here is the tension honest analysis requires. Whether this margin is durable or cyclical is the most important assumption in the entire 10x model. If margins compress back toward traditional semiconductor levels as competition intensifies, the math changes significantly. The bull case requires CUDA licensing and AI enterprise to sustain the blended margin above 50% even as hardware mix fluctuates. That is a real assumption, and it's one the next chart forces you to confront. A sorted bar chart of forward price-to-earnings multiples. At the top, Nvidia's own 10-year historical average PE, 53.7x. AMD at 30.8x. Semiconductor sector median at 29.1x. ServiceNow at 27.4x. Microsoft at 21.5x. And then the electric blue bar. Nvidia today, 21.6x forward earnings. The company with 55.6% net margins, 114% ROIC, $216 billion in revenue growing at 65% annually, and a software moat 30 times larger than its nearest competitor, is trading at nearly the same multiple as Microsoft. 25.7% below the semiconductor sector median, 60% below its own 10-year historical average. The market is applying a chip company multiple to a business that is structurally becoming a software infrastructure platform. Whether that mispricing corrects partially or fully is one of three inputs in the final chart's math. Starting market cap, $4.35 trillion. The 10x threshold, $43.5 trillion. Three scenarios. Do-nothing case, gray dashed line. Revenue grows at 10% annually, margins compress to 35%. Market assigns 18x earnings. The math is $475 billion times 35% times 18x equals $3.0 trillion. That's 0.7x from today. A decline. Not a disaster, just Nvidia failing the software transition and being repriced accordingly. Base case, white line, revenue grows at 22% annually, margins hold at 45%, market assigns 28x earnings. The math is $700 billion times 45% times 28x equals $8.8 trillion, roughly 2x from today. Real returns, not 10x. Bull case, electric blue line, revenue grows at 35% annually, margins sustain at 55% as CUDA licensing compounds into the base. Market assigns 35x earnings, lower than Nvidia's own historical average, lower than ServiceNow today. The math is $1.5 trillion times 55% times 35x equals $28.9 trillion. Approximately 6.6x, approaching 10x by around 2037. The base case delivers real compounding. The bull case delivers a 10x trajectory over a 12 to 15-year horizon, not 5 to 7. The full 10x requires either a longer runway or a TAM expansion from inference and sovereign AI that pushes revenue ceilings beyond $1.5 trillion. Charts 4 and 5 argue that's structurally plausible. Plausible is not guaranteed. The question that should linger: Nvidia is the fastest-growing, highest-margin, large-cap technology company in the world, and the market is pricing it below the semiconductor median at 21.6x forward earnings. Whether that gap closes in 3 years or 10 years is uncertain. That it closes at all, given the software moat, the ROIC, the margin structure, and the committed demand floor, is the structural bet this data supports. The math is there, the assumptions are visible. Now you know what has to be true. If you found this valuable, subscribe and hit like. See you in the next one.